Thanks, Reddy, and welcome. Today we're talking about banks' investment playbook in fintech and which banks have skin in the game. We'll drill into how banks are buying, building, and partnering with fintech and in what categories. I'm also really excited about this briefing because we're analyzing some of CB Insight's new public markets data, like earnings calls transcripts, to see what keeps top executives up at night and if their portfolios match up. To make this more of an interactive discussion, we're also trying something new, polling. Before we do all that, let's talk about some of the drivers fueling fintech growth and why now. You should care because banks are fighting a multi-front digital war. Digital interfaces are acquiring customers aggressively. Legacy infrastructure and mounting regulatory requirements are slowing banks' ability to keep pace with shifting consumer demands, and new products and delivery mechanisms are encroaching on all aspects of the traditional business. Key to understanding why next-gen platforms are growing is their delivery model, which is digital first, focused around reducing friction for customers, and highly iterative. Next is that because these platforms don't have the added spend of physical branches and operate in the cloud, they can pass those cost savings onto their customers in the form of lower to no fees, which here has lowered the high financial barriers for consumers in lower income brackets to enter the market for the first time. Today, the competitive landscape looks a lot different than it did 10 years ago. And there's no shortage of fintechs unbundling banks, attacking revenue, and acquiring your customers. Don't believe it? Using CB Insights, we've identified and tracked over 9,000 global fintech players, raising private market funding and gaining traction across all aspects of the industry. The breakout startups with product market fit have attracted millions of customers and are looking to scale into new markets and products, which for the industry should be a warning that threats on traditional business models are likely to accelerate. One reason they've been able to grow is that consumers are still finding reasons not to trust banks. It's been 10 years since the financial crisis, yet regulators continue to find widespread consumer abuse, which in effect pushes customers deeper into the open arms of tech firms. Another way consumers are exercising their unrest is by investing, and we've seen a number of stocks fluctuate as a result of bad press recently. But where this is particularly a dominant trend is among millennials, the hotly sought after next generation of consumers who stand to inherit $30 trillion as part of the Great Wealth Transfer. While that is a 20 to 30-year trend, we all know that the habits that you build when you're young around savings and investing tend to follow you. And what we're seeing is a strong preference among millennials for tech stocks over banks, which are viewed as more trustworthy among this demographic. While short-term, they are not the most desirable customers, longer-term, if tech firms deepen their financial services initiatives, consumers are likely to deepen their loyalty. But even if banks wanted to execute on these new sets of business opportunities, their legacy infrastructure can't be scaled quick enough to keep up with the changing consumer demands, not to mention mounting regulatory requirements and compliance deadlines. That's because existing infrastructure on average is about 38 years old and is coming up on end of life. Also, core customer work is still executed with on-prem servers that were never designed to ingest multiple data sets and are written in COBOL, the Latin equivalent for coders, the bulk of whom are reaching the retirement age. While the obvious fix here is migrating to cloud, implementation at banks has been slow. When they do, however, new sets of strategy can be executed like data capture, entry, and storage, which can help calculate churn, recommend products to cross-sell, and pinpoint consumer demand. And banks need to ship new products quicker, as bank revenues have been declining for products that were traditionally moneymakers like sales and trading and fixed income. Paired with the need to re-platform, now may be a good time to build out systems with those longer-term consumer demands, which is what the next wave of fintechs is already doing. Which brings us to our last point, that today's market is still primed with new opportunities for banks, but fintechs are thinking 2 moves ahead. While bank branches are shuttering at record rates, they are still burning money on the balance sheet. Meanwhile, fintechs properly identified mobile would be the next banking platform and met consumers where they wanted to be, which turns out is anywhere but a branch. Now, they're building out products tailored to demands like Revolut in the UK, a challenger bank, which is an example of a firm that has been rapidly releasing products, the most viral of which was cryptos. No platforms have been more viral than the crypto exchanges, which have capitalized quickly on the crypto hype, with Coinbase growing to over 13 million users in less than 5 years. And they're providing services at reduced to zero cost prices for customers. Robinhood already reportedly has more users than E-Trade, and when they close their next round of funding, will be valued at a third of the market cap in just 4 years. Meanwhile, 35-year-old E-Trade's legacy infrastructure just crashed, which may be a signal it's time to invest in new ways to monetize and retain customers. Again, no shortage of promising opportunities ahead in financial technology for both banks and fintechs, but I'm curious if you agree. So let's take our first poll. Which fintech insurgent do you believe is most disruptive? Ant Financial, Robinhood, Square, Coinbase, or none of the above? All right, I'm going to give you all 10 more seconds before we close the polls. Oh, it's a mixed bag. It turns out Robinhood seems to be top of mind for most, with Ant Financial in close second, which is interesting because all of you have very different perspectives on where that goes, which is great because there's a lot of exciting opportunities. And if you selected none of the above, that is, of course, because there is a wild card choice in all of this. The tech firms, right? Francisco Gonzalez Rodriguez, the chairman and CEO of BBVA, has forecasted that the industry's next big threat might actually be the big tech players like Amazon and Google. In response, BBVA and many other firms are putting skin in the game and bulking up their fintech playbook. Themes we've noticed among this cohort are what they prioritize, major shifts in their investment thesis, and lagging indicators that drive investments. On earnings calls in particular, we determined which bulge bracket banks talk up their own digital capabilities the most, and noticed that mentions of digitization jumped for Bank of America, Wells Fargo, and Citi in 2017. Comparing that with their fintech investments, we can see that the most consistent heat in fintech investing has been in the payments and financial services software sectors, which, given the legacy infrastructure coming on end of life, paired with the push to digitize, is aligned. Banks have also generally been slowing down their investments relative to 2016, something we'll dig into in the next theme. What's also interesting is that investing in infrastructure, a near-term problem, takes priority for US banks over blockchain, a longer-term solution. Specifically, banks have been sharpening their focus on updating infrastructure and capital markets software across sales and trading and communications. European banks have shown a similar pattern of slowed fintech investment in 2017 relative to 2016, but in Q1 2018, however, they picked up the pace, participating in 11 deals. Similarly, most heat in the category has been in the financial services software sector over blockchain. A focus on building up a compliant infrastructure makes sense given Europe's pending regulations like the UK's open banking and EU's PSD2, which went live preliminarily in January, and require banks to open up their APIs to third parties. Combined, these banks have invested in 9 blockchain companies versus 14 in infrastructure. Further, some banks are slowing down their blockchain investments of late. Although cryptocurrencies like Bitcoin continue to make headlines, from 2017 to Q1 2018, there have only been 2 new blockchain investments by this cohort, Axoni and Settle, and Citi participated in both. Axoni worked with Citi and JP Morgan on a successful test of its technology for credit default swaps. Of note, Goldman's portfolio company Circle bought Poloniex, a cryptocurrency exchange, and JP Morgan is looking to spin off its own blockchain project, Quorum, to win wider adoption. Though today it was announced they lost a critical executive, Amy Baldet. On the infrastructure side, we're seeing banks back a range of software providers, like Plaid, which offers a suite of API tools that allow developers to integrate with banks' infrastructure and access and authorize users' bank accounts. They were backed by Citi and Goldman and support thousands of institutions, including many of the bulge bracket banks we're talking about today. They've also invested in OpenFin, an infrastructure provider that uses software to help financial institutions create and upgrade trading applications. Though Bloomberg remains a dominant information services provider, the terminal is faced with a host of new fintechs supported by OpenFin that are appealing to users and tempting firms with infinitely customizable user experiences. JP Morgan is an investor, and Goldman Sachs' former co-head of technology, Paul Walker, joined the board in 2017. Also challenging the terminal is Symphony. Symphony is a communications and collaboration platform that was founded by and for the financial services industry. It is also backed by a number of top financial firms. Symphony's last round valued the company at $1 billion, and CEO and co-founder David Grellet will be at our Future of Fintech conference in New York in June, talking about how Symphony is driving replatforming of communications for the industry. Symphony is a good segue for the next theme we're seeing, which is that banks are forgoing investments and partnerships to building in-house to fighting fintech with fintech, in particular in the areas of lending, payments, and personal finance management. But unlike other industries like retail, banks aren't making acquisitions to expand into new products. In fact, only 20% of the top banks globally with US headquarters have made a fintech acquisition since 2013. Again, preferring instead to build the technology in-house. Banks have closed only 18 acquisitions since 2013, with 30% of acquisitions occurring in the last 7 months. Of note, JP Morgan acquired 2 payments-oriented startups in 2017, MCX and WePay. This aligns with the organization's goal of scaling ChasePay, the bank's payment solution. As more banks look to build out their own fintech products, more fintech M&A or acqui-hires could follow, but we're not ready to call it a buying spree. Drilling into Goldman's portfolio, they've been focused on building out retail lending and retail banking with Marcus, hoping to tap into new revenue streams that have shifted away from sales and trading and FICC. Goldman has made a series of investments in alternative lending, including most recently in mortgage lender MFS. They've also made a number of acqui-hires like alternative credit card lender Final and SMB lender Bond Street, all complementary to the firm's initiative to grow Marcus. Marcus is the fastest growing online lender to date. They reached $1 billion in originations in only 8 months. Fast forward, they've lent over $2.5 billion to 350,000 borrowers. Marcus differentiates their product from other alternative platforms by offering no-fee loans with flexible payback periods and installment terms set by the consumer, all aligned with the fintech growth drivers we discussed in the beginning. On deck, they are tackling retail deposits by acquiring GE Capital Bank and now hold $17 billion in deposits. They're also targeting a European expansion, taking on the likes of Zola and Funding Circle. The next area we're seeing banks bulk up in is in payments. As mentioned, JP Morgan is focused on payments and scaling ChasePay. Their largest bet in terms of making an acquisition is on WePay, which provides payments infrastructure and APIs for SaaS and crowdfunding platforms, including GoFundMe. A critical insight here is that merchants' primary financial relationship has shifted away from banks to payment companies thanks to their central role in online transaction and modern point-of-sale solutions. JP Morgan is trying to win them back, which makes sense because increasingly merchants are viewing their payments relationship more than their bank relationship as the gateway to financial services, including loans, payroll management, and customer rewards. So this acquisition will be highly complementary for Chase Merchant Services, which services about 4 million small business clients. And for WePay, they'll benefit from Chase's balance sheet, which will help them scale. Analyzing jobs data, WePay is hiring for a point-of-sale product manager and recently partnered with Touch Bistro, which provides point-of-sale hardware for restaurants, a move that will help them keep pace with companies like PayPal and Stripe, who have recently introduced instant payments, and Square, who in turn has started lending money to merchants through its Square Capital division. JP Morgan, as well as 60 other banks, are also looking to ramp peer-to-peer payments with Zelle. Zelle was acquired by Early Warning, which was founded by 4 banks and is backed by Bank of America, Capital One, and others. According to earnings calls from various partner banks like JP Morgan, Zelle reportedly transferred $75 million in 2017, but it was not revealed how many customers were serviced and what the repeat or active user rates were. Well, that's more than double what PayPal's Venmo reported. Venmo grew nearly 100% year over year and is only a portion of PayPal's payments volume. Further, Zelle has been in the press for security issues, which has harmed their customers' experience. And looking closer at the user experience, Zelle has yet to make a dent with loyal Venmo consumers. But Square's Cash App has. The Cash App has quickly jumped to the top of the App Store and has between 5 to 10 million downloads, on par with Venmo. Also partly driven by their supporting of cryptocurrencies, but is still incredible to watch. Looking at the average rankings though, with over 2 million reviews and 5 out of 5 rankings, it's clear Venmo is still the favorite among users. And for Zelle, on the other hand, they've been struggling with a fractured onboarding process because each bank has their own way of featuring and marketing the app. And as 2 of the examples show, it can vary dramatically across platforms. So for now, it's too soon to say if Zelle is really a Venmo killer, but payments is a competitive space we expect to continue to heat up more this year. One last area we think we'll see banks sharpen their focus on is personal finance initiatives. We're seeing early stages of this in wealth management as banks are buying and investing, building in-house, partnering, and white labeling fintech. Last year, Goldman sent shockwaves through the industry when they posted a role for a robo-advisor developer, but have yet to make any other announcements on their progress and quickly yanked the posting. Also building in-house are JP Morgan and Morgan Stanley. Morgan Stanley is the latest firm to launch their impact investing robo-advisor platform, and JP Morgan is still under development, but is projecting a 2018 rollout. Both are hiring specifically for fintech talent broadly, so we expect more product announcements to come. Our last theme is investments and partnerships are being driven by regulatory tailwinds. While RegTech investments by banks has been muted, many firms are projecting increasing tech spend on compliance. Looking again at earnings call, that investment is partially targeted on specific regulations, which have been top of mind on calls. RegTech spend may follow as regulations tend to be a lagging indicator as firms increasingly turn to tech to meet compliance requirements as the deadline nears. And something banks have been known to do is to co-invest in these types of solutions, as they did with Acadiasoft and now with Visible Alpha, to be compliant with the research unbundling requirements attached to MiFID II. Because again, banks and utilities stand to benefit the most from these types of solutions, and there's no shortage of pending regulations. So we'll continue to watch this space for developments. If that's not enough to keep up with, let's shift now to some of the things we think you should be looking out for in the coming years. Amazon. No discussion on bank competition would be complete without touching briefly on the e-commerce giant's latest foray into financial services. While banks are not talking about it on earnings calls yet, that may be intentional, they are chattering about it in the media. News volume spiked when Amazon announced a potential partnership with either JP Morgan or Capital Markets to offer retail bank accounts. And this is something I'm actually actively digging into for a special in-person briefing at our upcoming Future Fintech conference in June. So stay tuned for that. The next challenge for banks are the challenger banks, who are attacking banks across key retail banking beachheads, employing a digital-first strategy and appending monetization. For more on who the challenger banks are and why they matter, visit the research portal for a longer form explainer we published last month. What's also ahead for banks is succession planning. Notably, Lloyd Blankfein, CEO of Goldman Sachs, is rumored to be stepping down in 2019 as the firm turns 150. He's been a critical advocate for rebranding Goldman as a technology firm and refocusing the firm on growing retail banking with Marcus. It will be interesting to see how his successor picks up the innovation reins. Whatever is ahead, banks are not sitting idly, with many looking for growth in new markets, industries, and for partnerships with perceived competitors. But above all, to compete for customers' loyalty, user experience and user interfaces must drive many of your tech investment decisions because your customers care that the technology is easy and enjoyable. If it's not, there's an army of fintechs providing sleek interfaces and API integrations to provide that frictionless interoperability that users now expect. So with that said, and reflecting on how banks are innovated, I wanted to close it out with another poll before we head over to questions to see if you feel that your bank is innovating or not, and what that could indicate for your next ventures. I'm going to give it 10 more seconds, so I encourage you all to please answer the poll before we head over to questions. Alrighty, thank you all. It is a perfect split. Amazing. So on the flip side, that's great. For those of you that do not feel that you're being super innovative, I'm curious to see what you think your firm should be doing, whether that's buying a fintech, partnering to bring that technology in-house, or if you are going to be building it yourself. For those that are, you're ahead of the curve. But just a quick reminder, if you did like today's data that we drilled into and are having these types of discussions, you're not alone. And you've definitely come to the right place. So please reach out, as 81 of your smart peer firms have, to talk about how CB Insights can help either drive your innovation strategy or see what your competitors are up to. Oh, the report on the first question is, how do we get the report on challenger banks? That is actually up on the research portal. It is out now, so that's an easy answer. We will also likely look to turn that into a PDF, as it's been a very popular brief, and we should be sending that out. But you can access any of our research on CB Insights research portal, and a simple search should take you there. For customers in the platform, I would just use the top search feature to type in challenger banks, and that intelligence should show up. And also, if you are a member of the CB Insights community on the platform now, you'll notice that the challenger banks, such as Revolut, Atom, Monzo, who are all discussed in this briefing, will actually tag that brief on the new profile. So very exciting for you, so you won't have to do too much searching now. The second question is, are there any fintech startups for derivatives and other asset classes? Yes, absolutely. This was a bit of a focused briefing on where banks are investing, and derivatives is not a a hotly sought after area. I will note that they have invested in derivatives compliance with Detroit, but for more on derivatives specific assets and startups, I would say check out the capital markets technology research that we've done. We did a briefing last year, and there's a lot on the portal, including a market map of those types of companies. So again, a search that's easily obtainable. So the next question is, how does CB Insights see fintech disrupting investment banking and asset management? Very complementary. Capital markets, actually I see it less disruptive and more complementary. A lot of firms have looked to automate. Goldman has automated a lot of their trade desk leveraging software, and there's a number of startups that are providing solutions to help automate that. So that's more complementary in my view, but again, more deep dives on that in capital markets technology and in the briefing that we did last year. That's all accessible through the portal. Fintech and traditional retail banks require a different approach when it comes to regulations. How will regulators optimally narrow this gap without stifling innovation? That's a great question, and it's something that they're actively talking about. I think that for some of the regulators, a little bit more forward-looking is opening of sandboxes. We saw one open in the US last week, but the FCA has been a pioneer in this space, and we talked about this a lot in our last RegTech briefing, and again, we've got a lot of research out there, but I think RegTech and partnerships with financial regulators is their way of trying not to stifle innovation, but they understand that there's a delicate balance, which is what we're seeing play out somewhat in the blockchain and crypto arguments. They want to help, but at the same time, they need to be sure that they're protecting consumers, which is ultimately the end game here. Despite new entrants, the number of customers switching banks in the UK is declining. Why? I have not come across that data point myself, but I would think that might be changing to some degree. Revolut's already acquired 1.5 million customers. Monzo last week announced crossing 500K on the new current account that they have regulatory approval for. So they seem to be growing, and my assumption is that they're offering promotions here for switching, and they make it less difficult to switch, whereas switching from branch to branch is typically a cumbersome process. I think when we see companies like Starling offering opportunities for these consumers to switch between challenger banks, we might actually see that number increase. So I'm not certain where that data point again is coming from, but at least within the UK market, it's pretty strong in terms of switching. I think as these things come to the US, it'll be a lot harder as the regulatory landscape is fractured across state lines, so it will be harder for them to acquire customers. Which big tech is most equipped to compete in financial services? I'm personally in favor of Amazon. They've got key beachheads across the financial services sector. It's something we drilled into in our FinTech Trends to Watch. It's trend number 10, Amazon the bank. They've got payments, they've got card partnerships, they are doing lending. Now the volume is not on par with banks, but they're also, again, looking at retail partnerships with JP Morgan, Capital One. They were rumored to even be acquiring Capital One last year. So I think that they have the strongest position, and with over 70 million loyal Prime customers that already trust them, they kind of have that brand recognition. So I think that that's something on the less technical side that helps them if they had wanted to go that route. But who knows, right? Margins in banking aren't necessarily aligned with Amazon's core strategy for making, new market entries, but it is something that if consumers want, and he's a very consumer-driven person, he will build. So that would be my bet. Can banks be as innovative as fintech companies if they decide to develop new solutions internally? How can they compete for talent? The talent question is excellent. I think that there's a lot of initiatives for banks that are focused around talent retention and trying to attract new customers. Goldman has certainly done well rebranding themselves as a technology forward company. We've seen the likes of Final and Bond Street, younger startup driven entrepreneurs join Goldman, and as well as JP Morgan with WePay. So I think it's a slower trend, but to scale, if you really want to have that kind of impact in B2B fintech, you need to be aligned with working with banks. And then to the first part of the question, how can banks be innovative? I think that trying to establish separate and independent opportunities for fintechs to thrive, something that we struggled at my own firm with bureaucratic processes, is absolutely critical. If you can carve out opportunities for innovative internal startups to expedite the traditionally bureaucratic processes as they look to scale and look to find product market fit, those are ways to rethink how you manage innovation. And I think that that's all we have time for today, but there's a number of great questions coming through, so look for some follow-up from me directly or through Rennie. And again, thank you again for joining, and we look forward to seeing you guys at the quarterly FinTech update in a couple weeks. Thank you.